Hello, everyone. BigBear.AI Holdings, trading under the ticker symbol BBAI, is once again capturing the market's attention. As of the latest trading session, shares sit at $6.83, reflecting a modest decline of just over 1% for the day. On paper, that may look like a typical red day, but the story beneath the surface is far more complex. The stock opened lower at $6.69, briefly surged to an intraday high of $6.84, and has already seen an extraordinary 37 million shares change hands. This kind of trading activity is a reflection of two opposing forces colliding: the narrative of artificial intelligence hype and the reality of financial fundamentals. When we talk about BigBear.AI, we're talking about one of those tickers that perfectly encapsulates the current state of the market, where compelling stories can sometimes overpower the numbers. The name alone carries buzzwords that investors chase today: AI, defense, national security. Yet behind the headlines, there's a growing tension between what investors want to believe and what the company's financial reports actually reveal. Let's start with what traders are seeing right now. Despite its extreme volatility, BBAI's short borrow fee rate, essentially the cost of betting against the stock, is sitting below 1%. That's unusually low for a company that retail traders often tout as a short squeeze candidate. What this tells us is that professional investors, the institutions, the funds, the market makers, don't see any real scarcity of shares. There's no scramble to locate stock to short, meaning the so-called massive squeeze setup might just be internet fiction. This is the central contradiction within the BigBear.AI story. On one hand, you have the online narrative, social media threads and YouTube videos calling it the next Palantir, a small defense-oriented AI company supposedly poised for exponential growth. On the other, you have a set of financial statements painting a far more sobering picture. BBAI sits at the intersection of two of the most powerful investment themes of the decade: artificial intelligence and national defense. That's the kind of story that sells itself. The company has made headlines through high-profile contracts, such as its partnership with TSecond to deliver AI-enabled edge computing for the battlefield, and its support role in the U.S. Navy's Unitas maritime exercises. Each of these announcements helps reinforce the perception that BigBear.AI is embedding its technology deep into the infrastructure of U.S. defense operations. This is exactly the kind of imagery that excites retail investors: a young tech company winning defense contracts, potentially scaling into a multi-billion-dollar powerhouse. That belief is what fueled the stock's incredible 80% surge earlier this year, when BBAI rocketed from below $2 per share to a peak above $9 within a matter of weeks. For many, it felt like they were buying into the early days of a future defense tech titan. But then reality stepped in. The company's most recent earnings report, covering Q2 of 2025, delivered a harsh dose of truth. Not only did BigBear.AI miss expectations, but the results raised deeper concerns about the business itself. Revenue declined 18% year-over-year, dropping to $32.5 million. Meanwhile, the company posted a staggering net loss of $228.6 million. Now, to be fair, a portion of that loss was attributed to non-cash accounting adjustments. But the most alarming signal came from management's decision to withdraw their full-year EBITDA guidance altogether, a move that almost always hints at uncertainty or deeper internal issues. They also cut their revenue forecast, reducing the range from about $155 million down to $125–140 million. That's not just a slowdown, that's a reversal of momentum. Bulls will argue that BigBear.AI's $380 million backlog represents significant future opportunity, a pool of business that will eventually convert into revenue. But the bears counter that this backlog isn't translating into realized profit fast enough. In other words, having potential work on paper isn't the same as generating consistent, profitable cash flow. And that's where the market's daily drama comes from. BBAI isn't trading based on its earnings per share. It's trading on narrative momentum and speculation. It's become a trader's playground, where emotion, rumor, and volume dictate the price more than financial fundamentals do. The spike to $9.39 in mid-October was largely driven by excitement surrounding the TSecond partnership, a textbook buy the rumor reaction. The pullback to $6.83 shows the market digesting that excitement and realizing that one headline doesn't suddenly fix the company's revenue trajectory. With a beta above 3, this stock is extremely volatile. For day traders, that's a dream. For long-term investors, it's a source of sleepless nights. Now let's dig into the short interest, the heart of the squeeze conversation. According to the latest NYSE data, 17.74% of BBAI's float is currently sold short, roughly 76 million shares. That's a high number, and it's easy to see why retail traders view it as potential rocket fuel. The logic goes like this. If the company reports good news or surprises with strong earnings, short sellers will be forced to buy back their borrowed shares, sending the price soaring. However, that theory overlooks one critical metric: days to cover. For BBAI, that number is currently just 0.31. That means, based on the average trading volume, short sellers could close out their entire positions in less than a single trading day. Because the stock's daily volume often exceeds 150 million shares, shorts are not trapped. They can move in and out freely. That's why the borrow fee, the interest rate shorts pay to borrow stock, remains so low at just 0.71%. In comparison, genuine squeeze candidates can see borrow fees soar into triple digits. This tells us something important. Large institutions, including Citadel, Susquehanna, and Jump Financial, have no problem locating and lending shares. They're profiting off the enormous options activity surrounding the stock while collecting steady fees from both sides of the trade. For those following this stock closely, this data is publicly accessible. Websites like FINRA, NYSE, and platforms like Fintel track short interest, borrow rates, and off-exchange activity. When you see low borrow fees combined with high liquidity and low days to cover ratios, it's a red flag that the squeeze talk is more hype than reality. So, while social media discussions paint BBAI as a powder keg waiting to explode, the underlying market mechanics suggest otherwise. Adding another layer of complexity is off-exchange trading, commonly known as dark pool activity. Data from FINRA indicates that over 40% of BBAI's trading volume regularly occurs off-exchange. That means a substantial amount of buying and selling, including short selling, isn't visible on the public order books. This type of hidden liquidity can suppress price momentum and make it appear as if the stock isn't moving, even when significant trading is happening behind the scenes. Back in late September, for example, the company saw a spike in fails to deliver, instances where trades couldn't settle properly, suggesting periods of intense shorting pressure. While those have since declined, they contributed to the wild volatility seen in October. So what exactly does BigBear.AI build that attracts this much speculation? The company markets itself as a provider of mission-ready AI solutions. Unlike consumer tech firms, BigBear.AI isn't building apps or devices for the public. Its focus is on the defense and national security sector. Its core products include Conductor OS, a platform for managing and integrating various AI systems, and Veriscan, a facial recognition and biometric analysis tool used for identity verification and surveillance applications. Their systems are designed to help government and military agencies process and analyze massive amounts of data in real time, allowing for faster, more informed decisions on the battlefield or in intelligence operations. The problem, though, is scalability. Unlike Palantir, which operates with a high-margin software-as-a-service model, BigBear.AI is still functioning more like a government contractor, completing one-off, lower-margin projects. That limits profitability and makes consistent growth harder to achieve. Everything now hinges on the November 10th earnings report. That's the next big catalyst for this stock, and the stakes couldn't be higher. If BBAI delivers a surprise beat, especially on revenue growth, and reinstates positive full-year guidance, it could flip the narrative overnight. A strong report would challenge the bear thesis, validate the contract wins, and potentially squeeze out some of that short interest. But if the opposite happens, if revenue stays flat or declines again, it will reinforce the bearish view that the backlog isn't converting and the business remains unprofitable. In that case, price targets around $6 could quickly become the next floor. At this point, the heavy trading volume we're seeing suggests the market is already positioning for that binary outcome. The bulls are betting on redemption, the bears are betting on reality. BigBear.AI is a fascinating example of modern market psychology, a stock suspended between vision and valuation. It sits in one of the hottest sectors imaginable, but continues to face fundamental challenges that make investors question its long-term sustainability. For traders, the volatility is irresistible. For long-term holders, the uncertainty is exhausting. As we approach earnings day, one thing is certain. BigBear.AI will either justify the hype or become another cautionary tale of a great story colliding with hard financial truth. Whatever happens next, November 10th will be the day that determines whether BBAI's story evolves into a genuine AI defense success or remains just another speculative dream. This is not financial advice.